Firstly, I'd just like to say welcome to everyone who's joined us for the session tonight. We're really excited to actually be bringing it to you and partnering with our good friends from SprintLaw. It's fantastic to have you on the call as well. My name's Callum Davidson. I look after partnerships at Cake Equity. And, you know, we do a lot of work with founders and with our partners like SprintLaw, really helping demystify the whole process around streamlining capital raising, keeping investors engaged, and then also how to unlock the power of your employee equity. Tonight we'll be focusing around capital raising, but you know, if you do have questions around employee equity in that you want to throw in along the way, and we have time, would love to be able to address those as well. Just a quick note, we always get the questions around, will this be recorded? Yes, it will be recorded. It's been recorded at the moment, and we'll send out a copy of the recording after the event. We will also send a copy of the slides after the event, as well as some of the tools that are actually referenced as we go through there. We've got some great tools that can help you streamline your capital raise, which Jason and Ishita will talk to as we go through as well. So just to introduce our two speakers for tonight, we've got Jason Atkins, who's co-founder of Cake Equity. Jason has literally helped thousands of founders out with capital raising, so you're in very good hands in terms of you know, him talking about this area. He actually knows this subject from both sides of the fence, right? So he has led numerous funding rounds for startups himself. He has mentored literally hundreds and hundreds of startup founders through this process, but he's also sat on the other side of the fence as well. He was the CFO in a past life, which he doesn't like to talk about very much, but actually led the investment side for a major family office in Australia, and so has seen the whole investment perspective from both sides. So it's somewhat uniquely placed in that respect. He's a absolute a fanatic when it comes to supporting startups in the startup ecosystem. Not only is he involved in his own startup, which is Cake Equity, but very involved right across the startup ecosystem, as I said, mentoring, but also investing in startups as well. So thanks for joining us, Jason, and giving up your time. And Ishita is a senior lawyer with SprintLaw. She has extensive commercial legal experience, and is an expert in helping out structuring funding deals, and particularly in the startup space as well. So it's great to have you speaking today, and she'll be addressing all the more technical elements, all the difficult questions. I'm sure Jason will be thrown over the fence to be answered. So thanks very much for joining us. I'll hand over to you, Jason. Jason will kick off, and then we'll go through some of the more technical elements as we go through. As I said, we want to make this as interactive as we can. So if you do have questions as we go through, feel free to drop them in the chat. If we don't get them to them during the call, we'll have time for Q&A at the end. Thanks, Jace.
Thanks, Cal. Thanks everyone for joining. Yeah, delighted to be running this event today with SprintLaw. Look, Kate loves working with SprintLaw. I think the way our software is set up to standardize and streamline and automate many of the steps certainly saves a lot of time and money for startups, which is something that we love doing. We know startups have, you know, really trying to make the most of their time and their funding, but it's still very important to have that professional technical expertise, you know, with you along the way. And so, you know, we love working with clients with SprintLaw and putting on this event together as well. As Cal said, please do share what you're up to. Please do put things in the chat. We'll be looking at it as we go, and it does make the whole discussion a little bit more interesting for everyone if we can go and actually answer specific questions along the way. I absolutely love that Michael Bombers has already got one in there. So very happy to cover that one for you, Michael, as we go along. And I think, you know, the timing of when you run your raise, how you do the preparation phase, and then how you run your marketing phase, how you close it out is so important in getting a successful round done. So we'll definitely talk about that as we go. So look, just quickly on us at the moment. So Cake's now set up in 5 countries. So expanding really quickly around the world. We're looking to bring best practice from around the world and provide you with really great capital raising employee option tools. Partnering with Sprint in Australia, where we're just loving working with the Sprint guys in Australia and the UK as well now. So I'll just jump straight into it now. So I'm going to talk about raise hacks. I think specifically in the first 2 or 3 rounds right in the beginning, raise hacks are critical. We don't want to be bogged down overly, spending a lot of time and money on creating very complicated documents and models and things like that. For the friends and family round, the seed round, up to Series A, sometimes there's another round or 2 in there, depending on how long it takes you to really get to those Series A milestones. We want to simplify and streamline and get through these rounds as quickly as we can without making mistakes, so that when we do get to the later, more professional rounds, your cap table's in really good shape. It's probably no surprise, that globally, we're in a record year. It's been record quarter after record quarter, really around the world. I'm pretty sure the UK holds the world's 3rd biggest startup market. So, London particularly, very, very hot. Great time to be raising. Valuations are high. There is a skew towards the later rounds. So, Series A, B, C, there's more and more money. Is a little bit, I guess, less prevalent in the early rounds. So this one's particularly, more so for your newer founders. And, Ishita, please jump in here, wherever you like as well. But what I've found is that quite often early on, founders just get a little bit tripped up here, not really understanding that investors kind of want to see rounds that fit, within these sort of buckets, as you say, as I sort of determine them. So if you, for example, are doing a pre-seed round but you're raising, £5 million, it's just not going to look quite right to the investor, and they're seeing a lot of deals. So it's really quite important that you do try and understand that these sort of parameters are there. So for example, in the pre-seed round, and we've got this data from experience and also from TechNation, raising at a valuation of 1.5 million up to £5 million, about 10% of your equity would go in that pre-seed. We always say you want to try and maintain 70 or 60% at least when you get to your Series A, if you can. So when you're doing your pre-seed and your seed round, sometimes there's a seed 2, sometimes there's a pre-Series A. So you need to take all these things into account. You want to try and maintain as much equity as you can, but you have to understand that the investors want, some of the company when they invest. So they're going to want, 10 to 20% per round every time they invest. So for a pre-seed, raising 150K up to 750, for seed, 750 up to 3 million, and then Series A, 3 million up to 12. And with some of the big rounds, of course, getting above that, especially this year with the way the funding situation is going. Also important to allocate percentage of your company into an employee share option plan or ESOP. There's some good schemes there that you can take advantage of. So, around 10% is a good way to start out right in the beginning. You'll normally be able to keep that 10%, through the seed round. And then after your seed round is done, you probably go hiring more people. You may need to increase the size of your ESOP at that point.
Yeah, to add there, Jason, I'd say that we advise the clients, that you will have multiple rounds of investment through your startup journey. So you have to be very mindful how much equity you give away, because at the end of the day, when you exit the company, when you sell it probably to a competitor, then the ownership that you have, at that time determines your, financial position, basically. So you have to be very mindful when you, with your pre-seed rounds and your seed rounds, should not give away too much equity at that stage.
Yeah, great. And that's a perfect segue into this next slide. And, for the more advanced founders, for founders with a financial or legal background, this will be a little bit easier to understand. But I do like to stress this one because I've seen a significant proportion of early stage founders, and this presentation is really targeted towards, pre-seed to Series A, and we're all learning. So Cake is around a Series A company now. We've been through multiple rounds. I'm constantly learning, and you do really need to constantly keep sharpening the saw with this stuff. And what I would like to highlight here is, say, in the seed column on the left-hand side, the gray box, the 30%, that's one founder's allocation. So they own 30%. At the bottom, it's a $5 million post-money valuation company, which means that their 30% is worth $1.5 million. So that's in the beginning at the seed stage. At the top, you can see the investors own 20%. And then over time, the investors go to 47%, to 60%, to 68%. And it can be hard for founders to understand the mathematics of that, and the feeling of having your percentage of the company going down and down and down is a real feeling. Even now, with all the knowledge I have and all my financial background, as my percentage is going down, it doesn't feel good, and you do need to constantly remind yourself of why you're doing it. And the concept is, when you're a seed stage company, it's a small cake. When you're a Series C company, it's a really big cake. So even though you own less of it, it's worth a lot more. So in this case, the 12% that founder has in the Series C company, it's worth $100 million. So the founder has $12 million. So they've turned $1.5 million into $12 million, in approximately 5, 6, 8 years, or however long it takes to go through those rounds. So really great value creator for the founders there. I'm just going to set my alarm. Just give me one moment. Make sure that I don't talk too long on any topic, so we get time to get through everything. So here we're going to talk about simplifying everything. Probably, one of the bigger mistakes that we normally see, especially in the early stages, is companies just spending too long on a range of different tasks. And as a founder, you need to learn so much so quickly, and need to do so much all the time. Find product market fit, find the channels that work, raise capital, build a team. There's a lot that you need to do. And what we love to do at Cake, and working in partnership with Sprint, is just try and help you simplify everything as much as you possibly can. In a moment, we're going to go through a simplified valuation method, simplifying your legal documents, simple step-by-step guide, and things like that can really help make sure your round goes smoothly. So I'm just going to jump onto a different screen here and show you our capital raising toolkit. Can everybody see that? Yeah, I think that shifted fine. So what this capital raising toolkit is designed to do is to reduce the amount of time that it takes you to raise by 50%. So if it was going to take you 12 months, it'll take you 6 months. If it was going to take you 6 months, it'll take you 3 months, and so on and so forth. And trust me, there's a lot of things in here that can really help. So let's get into a few of those now. So I'm going to go through a few of these when we go through. So the valuation, the legal documents, and the step-by-step guide. You'll have to excuse my terminology here, but I really did want to make an impact with this. Very early on, it can be difficult for founders to be very passionate, very powerful. Why are they going to change the world? It is critical that you know that about yourself, and you're able to articulate that really well. Finding great investors. We've got 5 lists here. If you don't have these, hopefully they're helpful. We've got these from a bunch of our great partners. There's a long list of funds, accelerators, and angel networks on this one. There's a long list of VCs on this one, and so on and so forth. So if you don't have these, please check them out. I'm going to now put this in the chat so you can get access to this now. Cal will also send these things out afterwards via email. So make sure you're getting access to it, as many investors as you need to. This next one's quite important as well, and a mistake that we often see is that founders may make the mistake of meeting an investor and then immediately asking them for funding. This is not going to work. in the the vast majority of situations. They also make the other mistake of meeting an investor and then not following up afterwards. So here we have an example of a monthly startup update template. It tells you what you should do and why and who you should send it to. And the objective here is to meet an investor, send them monthly updates, and then when you go to run your round, you meet them again and you tell them that the round's opening. What this does is it builds trust for you. If you don't do this, so just say, for example, you think you've done a really good job. You've got a step-by-step guide like this to help you with your investor readiness, and you've gone through all these steps and you think, fantastic, I'm ready to raise. Well, that is the equivalent of building your product without talking to your customers. It very, very rarely works. It almost always ends in disaster. What you need to do at the same time as you're doing all that preparation is building your investor list and building that trust. If you don't, when you go to start running the round, so what we call stage 2, the marketing stage, you'll start this marketing stage, and instead of the marketing taking 1 month, it can take 2, 3, 4, 5, 6 months to do your marketing, because you need to build up all that trust while you're running your round. So you can see how if you get these things out of order, you can delay your round significantly, which can have huge impacts, obviously, on a small company with very little funding and runways running out, as they always are. There's also here a note about notes and safes. I know that safes are not popular in the UK. Perhaps, Ishita, this is a good opportunity to talk through notes and the right instruments to use in the case where you're not wanting to run an actual equity round.
Okay, thanks, Jason. So I'll start with the convertible note. So a convertible note is essentially a loan agreement, which says that if the founders or the startup does not pay after a certain period of time, then the loan will convert into equity. So this is a simple loan document, debt investment. The other is a safe note, which is obviously called a safe note in US, Australia, and Singapore, and jurisdictions like that. In the UK, it's called an ASA, which is an advanced subscription agreement. Now, this is like, it's like a conversion instrument, but basically the investor puts in money in the company and the shares are allotted at a future date. So it's quite popular, I'd say, with UK investors because of the simple reason that the UK tax government has these tax relief schemes, which is called the EIS and the SEIS schemes. And they provide tax benefits to investors for their investments. So for SEIS, it's 50% on their investment, and for EIS, it's 30%. So there are some, I'd say, certain criteria that you have to fulfill as a startup to be eligible to get the benefit of the scheme. So you should ideally check with HMRC, which is the tax regulator in the UK, whether that investment that you're getting is eligible for SEIS or EIS benefits. And it's a win-win situation for both the investor as well as the startup, because you get the investment and investor gets tax relief. Also, there are no capital gains tax on any profits that you make out of these investments. A point to note with respect to ASAs is that the long stop date should not be more than 6 months, which is essentially that the moment you put your money in the company and the time that it gets converted into equity should not be more than 6 months. If it is longer than 6 months, then you will not enjoy or can claim the benefit of the scheme, basically. So yeah, so safes are more they are popular. And for convertible notes, you don't have this EIS and SEIS tax relief. So yeah, so
they're not very popular. Not very popular because of that reason, right? Most investors are looking to capture that SEIS or EIS tax benefits, aren't they?
Yeah, mostly angel investors are looking for that. And SEIS is obviously your seed investment, and EIS is slightly more like your, slightly higher than that, like a Series A. So yeah. So if you need more information about these EIs and FEIS, we're happy to help you, figure this out. To reach out to us.
Great.
Yeah, over to you, Jason.
And then a couple of the other key legal agreements. Shareholders agreement would be probably, quite often, one of the most important documents in an early stage company's life.
Yes. So once you have the investment, it is, very important that you should have a shareholders agreement. This is essentially the rights which each shareholder has in the company. And you as a founder, you should be very mindful of what rights you're offering to your investors, especially at the seed round and pre-seed round, like having a board seat. You don't need to offer a board seat if someone's investing to 5%, 10%, right? Because essentially you have to understand that board is something like directors manage the company. So you have to separate that. Another thing is the preemption right, which essentially means that it's a right of first refusal on the shares. So you as a founder, if you have two other shareholders and if they sell their shares in the company, then you should have a right of first refusal on those shares. Basically, they should be offered to you to buy. If you're not, then you can sell it to a third party. Then, oh yes, there is a slide there for the term sheet. Another right I would say that is very common is a tag-along right. Now, if you are a founder, say with a 70% stake in the company and you're preparing for a Series A round, and there's another investor, who has 30%. And when you want to sell your shares in the future after your Series A round, then if you have a tag-along right, this will be the investor has a tag-along right. So if you sell your majority shareholding in the company, then the investor will have a right to sell their shares with you. And opposite to this is a drag-along right, where you have the opportunity to drag the minority investor with you in case of a sale. So there is a combination of these rights. They are very common in shareholders agreements. So I always advise my clients that you have to see the overall picture in the deal. If something fits you, go for it, but you don't have to accept, everything. Like every template is not for, you. It's accustomed to separate deals. So, and the other important.
And for those of you that don't know, the term sheet is normally a summary of all the terms, and these sort of terms that we've highlighted here are some of the more common and important ones. They'll then be found in the shareholders agreement. So if you've already got a shareholders agreement and you signed a new term sheet, then those terms will then be added into the shareholders agreement before the deal will be finalized. If you don't have a shareholders agreement, and the shareholders agreement will need to be drawn up, by a lawyer between when the term sheet is signed and when the money gets in the bank and the shares are issued.
Yeah. So term sheets, always founders, you should have a term sheet ready for your investors. Basically, it gives you, it shows what kind of rights you're offering the investors. And sometimes, when you're getting an investment, you tend to get excited and then you may offer too many rights. So you should always have a template ready, which has the bare minimum rights for that round. Yeah.
That's so true. I remember when we did our seed round, and so I have a finance background, but my co-founders, and this is very common. Well, it's actually not that common to have a financial founder, but anyway, so quite often you'll have, like a technical founder or a domain expertise founder, perhaps someone with a sales and marketing background or what have you, right? And I really highly recommend getting like a standard term sheet or asking your lawyer for a standard term sheet to have a look at in advance, because to understand all these terms at the last minute when you're under pressure to sign or do the deal is really a bad time to be reading these things, because they're so technical, they're so complicated, and they're so important. If you get them wrong, it can have huge effects for the whole rest of the life of your company. So we sat down as founders and we got the, in Australia, the Airtree open source term sheet out, and we just read through all the terms. And trust me, it was a really tough conversation, because they don't feel good. It doesn't feel good to have to give rights away or have veto rights, or, you know, there's quite a range of them, and quite a few of them don't really feel great as a founder, especially if you've never experienced them before, but they are there for a reason. They're there to sort of help put balance between the company and the founders and the investors. They're there to help protect the investors' money, but also protect the founders. It can go a little bit too far towards the investors or the founders, probably normally towards the investors. So you've got to be careful because they're very smart, and, you know, we don't want to do the wrong thing by the investors, but just be aware that sometimes they're going to put things in there that are a little bit their way, and you do want to have a bit of experience with that before you go and sign your first term sheet.
And also, Jason, if you have very, too many rights offered at, say, the seed stage, the Series A investor will want to have better rights, so you have to, kind of level it, as low as possible.
So true. Unless you get a really good like Series A investor, and the investors, your early stage investors are just happy to be along for the ride. But yeah, it's totally true. Each round wants better. Cool. All right, thanks. So let me just find where I was. I just need to go back and share my screen again. Oh, hang on, I managed to lose it somehow. There it is, hidden away. Excuse me for a sec. All right, so where were we? We talked a bit about the legal agreements. Thanks heaps for providing more context there, Ishita. And I'll just jump back into where we were. So back to the capital raising toolkit. So we talked about notes and safes. The next thing I want to talk about is the step-by-step guide. And this gets us into talking about the rounds, the stages of the raise, and how important it is to really treat them as clear stages. Just before I go ahead, I'm going to check for questions. Doesn't seem to be any. We had the one earlier from Michael who said, we're starting to prepare for seed, particularly interested in your views on how to manage the list of potential VCs, one approaches, and what you think about setting a strict timeline. So we are going to go through this now and just talk a little bit about how to create energy in your round. So there's lots of things you can get wrong in a raise. I'm not going to sugarcoat it. Like, it is really hard. There's the cap table aspects, there's the legal aspects, there's financial, there's preparation, there's pitching, there's closing. It's a hard thing to do. It's normally kind of a full-time job for one founder for an extended period, sort of 3 to 6 months. And that's kind of how it is. I think it's very good conditions at the moment, so it can certainly be done faster, but you should, be as prepared as possible. And what I think, one of the most important things you can do is actually prepare well. So get all these things done in this section before you go on to the next section. If you come into this stage 2 marketing and you start sending out your deck and you start having meetings with investors and you haven't got a strong, you haven't done this part here well, this part here will take much longer for various reasons. The first reason will be you will have a good meeting with an investor, but you won't be able to follow up with, a full pitch deck and a data room for them to look at. And then 2 things can happen there. 1, it just gets delayed. If they really like you, they'll wait. Or 2, they'll be on to the next deal almost immediately because there's so many opportunities. So really important that you get your preparation done. The second reason why it's so important to do all this work before you get to here is because, as Michael asked, then you can put timelines on this phase. And in my opinion, based on my experience, if you can't put pressure on the investors to say that the round's opening, it's closing on this date, I'm having all my meetings in this period, we're looking to have a term sheet by week 4 or week 6 or whatever you set that time frame within, then you don't create that energy, you can't create the FOMO, you can't control the narrative of your round. So really important that you don't go to this phase until you've done this phase. Now let's talk about it. Here we have a short pitch deck and a long pitch deck. Over here, I'll sort of go into that in a little bit of detail, but the short pitch deck is for sending out in advance of the meeting. It's essentially a high level summary, approximately 10 slides. It's designed to get you the partner meeting, to get the serious meeting, to get all the decision makers in a room together. Then you pitch, the 30-page deck. There's a lot more context in it. It may have, the really complex stuff in the back in an appendix or something like that, just so that it's palatable for the presentation. The goal of that is to get the term sheet. It's essential, obviously, to get a lead investor. If not, then you sort of lead into a bridging round. So that's when you might end up, with a C2 or a pre-series A or something like that. If the investors think, you're not quite ready, for that main round. Obviously, with your DD, be prepared. There's a range of different software providers out there. I personally think something as simple as a Google folder, works really well. And we've provided a checklist here for you. I'm just going to show you that now. So in here, there's a really great data room checklist. So this will help you with, the overview, the governance documents, the market research, information about your tech, any material contracts and agreements, patents, trademarks, and other matters, regulatory matters, borrowings, and your people items and insurance and legal. So, as a very, very early stage pre-seed company, you're not going to have a lot of these things. You need to have an adequate amount. As you get into seed, you need more information in here. As you get to Series A, the information requirements are really quite high. And at that point, the investors are expecting quite a professional amount of information, quite thorough, quite detailed, across all these items to be able to get those A rounds done, because, they're 5, 10, 15 million pounds plus. And of course, they're going to expect, some pretty serious documentation to be able to verify, all the bits and pieces about your round. Ishita, anything to add there?
Yeah, no, just the point that investors will appreciate if you have your, licenses and compliances in place. So make sure your company's house filings are in order, all these tiny books, your statutory books are in order. So these tiny bits, and even your agreements should be like properly executed. And because, at the due diligence stage, the investors, the lawyers will typically go through each document to see if that has a financial implication on the investor. So after the deal, so you have to be, you should get all, so these are minor cleanups, so before your round, you should have these done. That's advice.
Oh, for sure. So there's two outcomes that can occur if you don't have them done. So the first thing is, so just say, for example, you give them a spreadsheet that shows your cap table and they go to company's house and they do a check and they don't match. They're going to think two things. One, you weren't prepared and you made a mistake. Or two, you don't know what you're doing, or, worse, that, you've omitted something. I think quite often they're not going to go for the omission, angle, but even still, you do not want to be showing that type of, difference to an investor. It's one of the absolute first things they're going to look at. I'm just going to jump around a little bit here over to this slide, just because we're talking about DD. The first and second things that they're going to do, once they like you, they like the company, they like the space, they see your growth, right? So you've made that connection on the commercial side of things. They're getting into DD. They're going to look at your cap table. They're going to look at the regulator. They're going to check if you've done a share split if you need it to fit the round in. They're going to check that you've got, your board and member approvals to make sure that the round, is approved already. Who has, preemptive rights, who has pro rata rights, all those things that, make sure you've got your approvals and waivers done. If you don't, the first thing they're going to think is, it's an oversight, or it's, just a lack of a skill. Not the worst thing in the world, especially if you're very early stage. They can give you some leeway, but not great. And then also, it might just delay. You've got to go and then fix those things. They can take quite a while to fix at times. And then the investor may have gone on to some other deal. So get that stuff sorted. Your cap table modeling as well. Make sure you know how many shares you have, how many notes you have, how many ASAs, how many options. Understand what that all means. What's going to happen after the round? What are the terms you're offering in your term sheet? How much are you happy to be diluted in the round? It's important to know that. Just say you want £1 million. You want to be diluted 20%. So you're looking at a $4 million pre-money valuation. Understand these things in advance. Really important, to make sure you get across these, to make sure your raise runs smoothly, and also that you don't cause yourself a major problem down the track, which is quite possible if you get one of those major things wrong. So just working down this checklist now. So the step-by-step guides, there's a data room there. There's a simple valuation tool in here as well. I find very early stage companies quite often get quite bogged down and find valuations very troublesome. In my opinion, as an early stage investor now, the rough rule of thumb is you don't want to, you want to dilute plus or minus 20% for each round, and you work out how much money you need, and then that essentially helps you back solve what your pre-money valuation is. Of course, it can't be way too high or way out of the realms of reality based on where the company's at, but it's a nice way, rough rule of thumb, to think about it. Obviously, ask around, read up, look at trends. There's also a really nice piece of software called Equidam that you can use. I've used it multiple times. It's really quite a cool way to do it. And it's also very common not to set the price, just to ask, just to set how much funding you need, and then, just express to the investors that you're looking for a fair offer based on the current market, and, get them to come to you, to talk about the price. And so there is a template here that you can use. It's got a weighted average methodology where you can use a combination of 4 early stage methods: a revenue multiplier, a by stage valuation analysis, future valuation method, and the Berkus method, depending on where you're at. So in this case, you might be very early stage, just at ideation with a prototype, and you might say, look, I'm going to use 100% Berkus method. And so here you would say, all right, I'm going to go 100% Berkus, and then down here I'm going to give myself a score of 7 out of 10 for each of these methods, and that's going to extrapolate out into a pre-money valuation. But perhaps you're a little bit further along and you want to say, look, I want to be 50% by stage, 50% by Berkus method. You can come down here and say, all right, well, I have an MVP, I have some early customers, and I have some partners. So I'm going to value myself based on this by stage method down here, at 5 million. And then it'll automatically weight those two out and give you a 3.35. Now, there's no such thing as an exact science for early stage valuations. But what this does do is it gives you a method to start talking, practically and intelligently with the investors. I normally recommend doing this in conjunction with your advisors, so that it's not just your opinion. If you put this to a couple of your advisors or a few of your advisors, you get them to fill it out or help you with it, you probably get to a reasonably good valuation that you're happy to go out and use. And you can literally do that in just a couple of hours. And I've seen startups spend a lot of money and a lot of time on valuations that really don't help their cause at all, because most investors will put a valuation on your company within 10 minutes of looking at your pitch deck. So the legal documents we talked about, there's also an investor CRM here. I'm just going to flick across to that now. Here somewhere. That's not it. Here we go. So here's where we again get into controlling the narrative of the round, controlling the energy and speed and power of the round. So in this case here, we've got this company wants to raise 2 million. It says dollars, but this is an Australian example. So they want to raise $2 million, pre-money valuation of 12 million. So that'd be 14.29% dilution. If you raise the maximum, the dilution obviously goes up. The main things I want to highlight here, and this needs to happen in parallel with this preparation work. So if I go back to here and I get this step-by-step guide, you'll see all these steps that you need to do to get ready. Building this investor list is one of the most important things. If you go into this phase and you don't have enough investors in your list, your raise will take much longer unless you're very lucky. And I know it's a very good funding environment, so we may all be able to get our raises done very quickly, but you don't want to take the easy option, because if you don't get it right, the raises can take ages and you can run at a runway. So the reason you don't want to go here without enough investors is because the investors know that you aren't ready. They will know if you don't know enough investors because of the way you pitch, the questions you ask, and the timeframes that you give them. If you know you've got enough investors and you know you're going to raise the money, you'll be saying things like, we're opening today and we're closing in a month. You know, we're having all our first meetings this week and we're aiming to have our second meetings next week or the week after, so that we can have a term sheet in week 3 or week 4. Now, you may do it over a 6-week period, but it'd be very similar style. What that does is it shows the investor that you're prepared. You've got your stuff ready, you've got your list ready, and you're ready to go. And it puts a lot more pressure on them to engage with you. And also then after the first set of meetings, almost always when you run it like this, some of the investors will come back and they'll want more information. That allows you then to go back and say to the other investors, some of the investors are progressing. Do you want to progress? What's your process? And it really allows you to control the narrative. So whenever you're in this phase, the investor readiness phase, you do not want to ask for money. You only want to ask questions like, as it says over here in this template, you know, how much do you normally invest in each round? You know, I saw that you normally invest in my niche and my stage. I just wanted to confirm you would be open to me pitching you when I open my round in XYZ, right? Next month or next quarter. So what you're trying to do, the first thing you're trying to do is get a list on the all the way down the left-hand side here of any investor that you think might invest in your round. Then you want to have the, you know, who in your company owns that relationship? What's the LinkedIn link of the company, of the investor? What notes do you have? Have you met them? Have you not met them? Do you need to get a warm introduction from someone? Are you going in cold? Have you had a meeting? All that stuff goes in here. Then the next action, so making sure you're always following up. Investors love it when you follow up. You meet them, you follow up immediately. They ask you a question, you follow up immediately. Bam, 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 bam. That's also so important, you know, why it's so important to have all this information ready. If they ask you a series of questions and you can't follow up the next day, then they're going to get bored or red flag you. Okay, so it's like follow up, follow up, follow up. So the first thing is you do is you put all the investors in here that you think will invest, right? So this is, you know, just, you know, for argument's sake, I'm just going to do this here, right? So in this case, we were trying to raise a $2 million round. So our target 10 times 10, our target in this column is 20 million. So we want 10 times what we need to raise in this column. This is your starting point. When you're starting right before, way before you raise, when you're just doing all this stuff here, you want to get this list together. Now, while you're chipping away at all these things, then you want to try and get this next list together. I'm going to try, I'll cut this bit off just in a moment. Just give me another minute. It's really important. Then you want to get this next bit together. So in this section here, your target is 3 times what you want to raise. What that means is when you actually go out to raise, you know that, you know, investors that normally invest 3 times what you want, who know you, who've spoken to you, who've had your updates, who've seen your preliminary deck perhaps, they're ready, they're happy for you to pitch them, then you are ready. You know what I mean? That's when you know, once you've got that list ready, once you've got all this stuff done, then you go to the marketing phase. And this is how you control the narrative of your round. Gives you a much increased chance of success, better investors, much shorter overall time frame to raise, you know, a lot more success. And then once you get through that, you go into the closing phase. There's a little bit of DD quite often at the back of this phase, just where they, you know, they normally do commercial DD here. And then they'll give you the term sheet. You sign the term sheet after, of course, looking at the terms in it, checking that you're happy with them, talking to your advisors and your lawyer and stuff like that to make sure that you understand what the terms are. Ideally, you know, you're doing that prep work with your founders beforehand. And then you go into the closing phase. So final due diligence, that would be the, you know, the technical, legal, and sort of, you know, financial DD. And then Ishita might sort of open this up for you as well. This is where we get into sort of the document signing aspects of it as well. Quite important that they all happen in the right order.
Yeah, that's true. And make sure that all your closing documents have been prepared, all your resolutions are in order before your closing. Last week, we had a transaction where the founders did not have share certificates ready. They had never issued them. So, these things, you should ideally have a closing checklist ready at least like a week before your closing. So that, on the day of closing, there are any glitches.
Yeah, I mean, a good close will take sort of 2 or 3 weeks. A bad close can take 2 or 3 months. And I'm not exaggerating. And if you're running out of money, as most startups, raising quite towards the end of their runway, you can't afford to leave these things to the last minute. And even still, like a really badly set up cap table or company's house, or perhaps there was some shareholder on your cap table that you didn't get a waiver from, and then they come in at the last minute and they block you around and they extort you to get better terms and things like that. You don't want to leave that all to the last minute. So those are the things you want to cover up here, so that this can happen bam, 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 and you can get the money in the bank nice and quickly, issue the share certificates, update the cap table, update company's house, update your balance sheet, all those things that Cake and your lawyer and your accountant, and people like that can help you with. So so that's a bunch of stuff from the capital raising toolkit. There is some other things in here. You've all got the link, and we'll be emailing it out afterwards. There's some resources, there's some webinars and videos. There's an explanation in here about what Cake does. I am just going to quickly segue there into the Cake app itself and just show you around a little bit, just so you get a bit of a feel for what it does. I'm just going to pull that one out of the way. Cake Equity India, interesting. Where'd that come from? All right, so here we go. So this is the Cake app itself. This is a Australian example, so it's all dollars, but the UK version is really very similar. We have regionalized Cake for the UK and the other countries. What that means is that the legal contracts that are built in are UK specific legal contracts, and it's got pounds, of course, and the database matches with company's house. So the fact that it is regionalized for the UK makes it super helpful. Of course, in here you have all your shareholders, what percentages they own. There's obviously bulk uploads. You can add and transfer and split and buyback and all that sort of stuff. You manage your employee options in here. You manage, notes and ASAs in here. The transaction histories in here. There's, you can do share transfers. There's a raise workflow for running your capital raises that again has contracts built in here for the UK, whether it be, a subscription agreement or what have you. And there's a workflow here for sending and signing all the documents. Similarly with an option plan, in here we have the contracts themselves, the details of the option plan and the summary, and then you can very simply add an offer. And how we work with SprintLaw, when you're putting one of these things together, Sprint will help you to review and finalize all these contracts and make sure that they're fit for purpose. If you already have your own lawyer, that's totally fine as well. But if not, we do love working with Sprint to make sure that these plan rules have been reviewed and they're fit for purpose for you and you understand them well. If you're not sure sort of how the offer letter works and how that's going to tie in, Sprint will help you with that. I'm just going to jump across to a UK company here. So this is a brand new UK company that I just set up earlier. So with an option plan, if you did want to do that, you can go and start an option plan here very simply, create a simple standard ESOP that'll then go straight through and create that for you. And then, it sets it up automatically with 10% in that case. The contracts are already provided for you here, UK specific EMI scheme documents, and so on and so forth. So just a really quick example of what Cake does. All your company details live down here. Your valuations and share types and board members are down here. There's a document storage and sharing area, and your investors and employees also have access, so they can view their holdings, view announcements that have been sent to them, obviously receive documents and store all those things in there as well. And whenever they've been asked to participate in an option plan for employees or an investor for an investor round, there's a whole signing workflow here where they sign all those documents inside Cake with a DocuSign integration. So So super helpful system there for anyone that wants to use it. We also have free setup, free onboarding, free upload. So if you send any of those documents to us, our team will set them all up for you, and then you can have multiple free onboarding sessions. And then where it comes to the legal technical components, Ishita and Adil are more than happy to help you through those as well.
Sure.
So we're getting quite close to the end. Really would like to open it up to questions. We've got a couple of other things we can cover if we don't have any questions, but definitely give you guys a little bit of time. So looking through here, does Cake also have materials, etc., for the US? So we do. So we have currently have Australia, Singapore, UK, India, and the US. So really excited to be able to help startups in all those regions. It is our goal in 2022 to expand to as many countries as possible. We do that, with the help of wonderful partners, like Sprint, where they can really help with the the more technical aspects as needed. But yeah, US is definitely a big one for us at the moment as well. Not sure exactly which other EU countries we'll go to next. The more prominent startup countries are, you're probably familiar with. Quite likely candidates for us for the first half of 2022 as well. So that was for Antonio, Michael, Alex. Cool. That's all the questions so far. Ishita, how we do? Did we cover anything or not cover anything that you think might be good to sort of finish with or to help the guys with before we wrap up?
I think we have most of it covered. It's just want to say that one has to be very mindful of what one is signing, and you should have a clear picture of how your round looks like. I mean, it can be a bit complicated and confusing when it comes to legal documents, and even the business bit. When it comes to valuations and the dilution bit, it can be a lot if you're not really in the practice of dealing with these concepts day in and day out. And some startups have brilliant ideas, but again, when it comes to these technical points, they might get held back. And that's why Cake has an excellent platform. They have kind of simplified all the legal and even the technical aspects on the website, like you just saw. And it's an excellent platform. And yeah, I mean, we are really glad that you're working with Cake on in this venture. And I think if there is anything that you wish that you need guidance or direction, just reach out to us, and we'll be really happy to help you.
Awesome, thanks. So I'm just going to do one last thing from founder to founder, which is just some tips. Look, raising is hard. Make sure you look after your health and your mental health. Don't give up. Keep going. Do look to accelerators and incubators. I've had a lot of success there, and I hope you all are turning to these hubs for inspiration. Do get the right resources. The Capital Raising Toolkit is a wonderful resource. We also have blogs on our website that will help you. And I guess that rolls into learning and keep learning. Every round you do will be different. Your pre-seed, your seed, your seed 2, your series A, they'll all be different. So constantly be learning, constantly be looking forward to the next round and try not work out what you don't know, because there's always things you don't know. Get the right advisors around you to do that. The last one there is purpose. I find, this is the most important thing really when you're raising. Where are you going? What's your ambition? What's your purpose? What is going to change in the world that is going to bring these investors with you? They need to feel that energy. Not only does it help them invest, but they know that it helps you get good team members. It helps your team members stay in a really competitive environment. So just keep honing in on that huge energy that you can bring to take your startup, way forward into the future, and it'll really help you, get success with your raise.
Thanks, Jason. Thanks, Ishita, and thanks everyone for joining us. As I said at the beginning, we will be sending out copies of the slides. We'll send out a copy of the recording as well, and the resources. Some of them were dropped in the links there, but there's a bunch of others that we'll send out over the next few days. And you know where to find us. Feel free to reach out on LinkedIn. or email us as well. So all the best, and thanks for joining us tonight.
Thanks
you.
everyone.
Take
Yes.
care.
Bye.
Thanks team. Have a good one.
Bye.